Hi, I'm Peter Rose, founder of Longwood Currency Trading. I'm outside again today. It's a beautiful day. It's supposed to hit around 90 again. So these are the first couple of days, and this will be early June by the time this gets published. I'm in the kind of the mid part of May right now of 2026. And so we're moving into summer in the Lakes region of New Hampshire, where I live. So I'm taking advantage of that. Why I only trade Forex major pairs. There's a situation this morning, for example, I'm trading one of the major pairs and I'm looking at price action. There were no economic indicator releases or whatever, and I'm sitting there and I thought, well, I'll grab a couple of 10 pips. That looks pretty good. I hadn't been I was just setting my desk up. I got a lot of emails. I got a lot of shit to do today. So I didn't have a lot of time to trade. So I had to pull the trading desk up, and I'm doing other stuff, and I'm looking at the chart. I'm going, yeah, man, there's just nothing going on here. We're trading sort of in a long range of a couple of hundred pips. So, you just don't know what the volatility is going to do. And I thought, well, I'll wait until after 8:30. I'm East Coast U.S. time, so I'll wait until after 8:30. If there's some minor results coming out today, and as I'll just wait till those come out and see if anything happens. And so I was catching up on some emails and glancing at the chart, and I thought, man, this just looks like it's overloaded a little bit. I think the price is going to go down. I don't know that it's going to be a sustained downward move, but I think it's going to move. So I'll throw a couple of limit orders up and just have a cup of coffee and continue on with what I'm doing. So I put the limit orders on. I'm sipping my coffee, typing out an email to a student, and I look back and the price had moved 50 pips. And I'm going, holy shit, what happened? Because it was the wrong way that I was in the thing for. So I thought, oh crap, I just got clipped. And I'm in a bad draw. It turned out that the price had dropped very rapidly, grabbed my take limit order and hit my stop. Boom, I'm out of the trade, and then the thing went 50 pips up in the other direction. And I went, phew. Now, I looked at some of the minor pairs and the reaction, minor pairs with USD, because I don't trade the crosses. What in USD we call AUD-NZD, for example, is a cross pair. It doesn't have a USD component. Yeah, it's not an exotic, which might be Taiwanese currency with Hong Kong or something, or Malaysia. So I look at the crosses and stuff, and life is fine. It was just a USD thing. All the USD prints were exaggerated, and it had 40 to 50 pip moves in like about a 1 minute frame. Oh boy. So even the USD current majors really move. When the USD moves, things really move. When we're looking at the other pairs that weren't affected by this USD move, you still see volatility that is unexpected, as this volatility was unexpected. But when that volatility goes, it happens many times more than it does in a USD-based pair, a major pair. And the extent of that volatility is radical, such that you'd end up maybe at the end of the day with a doji or something, even though you might have had a 40 pip run. I guess what I'm saying is we're looking at this price action that I witnessed this morning to be a representation of risk management in what you would put into your trading plan, right? In your trading plan, you're going to state, well, hopefully you're only trading one currency pair. I've done a lot of videos on just trading one currency pair. But if you're trading multiple pairs and you're, 3 or 4 years or less of trading, you probably ought to just stick with the majors. So you're either going to say, well, I'm going to trade Swissy, or I'm going to trade a euro dollar, or something like that, or NZD or something. Or you might just say, I'm going to limit my trading to the major pairs. And again, I'm not suggesting that you should trade the major pairs. I'm suggesting that you trade a major pair. And I mean, 47%, I think it's 47% or 50% of the total $10 trillion a day Forex market is in the euro dollar, pound dollar, and the dollar yen. So those are the three that you really should be focusing on, because they're going to give you the most liquidity. And that's part of the risk management that you have to look at, is you want to trade a highly liquid currency, so that you don't say, well, I'm only going to try to grab 4 or 5 pips here, and the thing goes 3 pips in that direction and then 30 pips in the other direction before you can hit the close button. So risk management is at the forefront of everything that I teach. And so when I open up a student to the fast track course, it's a 6-week course, I begin with a discussion of real risk management, not some of the stuff that you see people talking about online. This is practical risk management, not theoretical stuff. So when we're looking at trading, I only trade the Forex major pairs, and I specifically only trade one of them, maybe at a time. I might trade 2 of them, but not at the same time. I might change trading one. If I'm trading pound dollar, for example, which is more volatile than the euro dollar, for example, and it doesn't have quite as much liquidity as the euro dollar has, but then the euro dollar doesn't move very much in comparison to what the pound dollar does. So if you're fairly comfortable with pound dollar and what's going on, you're going to get a little bit more movement toward your reasonable profit targets in a shorter period of time. And that's part of the risk management. However, if things get really roiling in the USD world, because crazy things happen in USD that affect the whole world, you might want to switch down and go to euro dollar. Or if you want to totally avoid price, you might go to a cross pair, or whatever that would be for your particular country. You might do pound euro or something, and just get away from USD totally. That's why I only trade the Forex major pairs, because that's a risk management component that's in my trading plan. That statement of that part of your risk management does not belong in the framework of your rules, because risk management should be taken care of risk management external to your trading rules. You shouldn't have trading rules that are based on risk management. And if you're trading that stupid risk-reward ratio thing, what you're doing is you're managing risk and reward at the same time. And that's just craziness. That's not risk management. So when you're looking at serious trading development, what you're trying to look at is over the long term. What are my metrics going to be for the year, so that as I trade, I know what those metrics are, and I can be confident in taking what would appear to be offering asymmetric wins. I can, based on my metrics, I can determine, because when you try for an asymmetric win, you've got to change your risk profile a little bit, but that's not in your trading rules. That's in your risk management, in your trading plan. Then you've got a better idea of, well, if this goes bad for me, how will that bad extended risk affect my overall trading? Well, if you're, a 55 winner, then you might not want to do an asymmetric trade where in a volatile currency pair where you're extending your risk, or even taking the risk that you particularly have on an asymmetric move with a pair that could be more volatile than that risk profile is giving you. So you're going to run into those questions the more that you stray off of those three primary major currency pairs, euro dollar, yen, and pound dollar. And the more that you are going to be judging in your entry analysis and saying, oh, this looks like an asymmetric win possibility, you've really got to have that risk management malleable within the structure of your trading plan, so that you're not trying to figure that change in real time. Stutter here, because it's so critical that I get the terminology and the phrasing correct. The importance of risk management not being done in real time. I mean, when I'm working with a student, that's one of the harder things that I have to overcome in them, is because they're so used to going, well, I'll set my stop here and then I'm going to look for this number of pips, but I'm going to wait until you're complicating things. To give you a thing, not to get boring, but when you increase the number of choices that you have, you increase dramatically the number of solution paths that you have to consider. When I'm looking at a trade entry, that trade entry, I'm only looking at one solution path. I have a trade entry rule that has a solution path of conditions which are in sequential order. So if the first condition is true and the second condition is false, I'm out. It's not, I don't even think about it. I just forget about that whole thing. It's out. First condition is true, second condition is true, third condition is true, then the rule returns true. So that's a linear way of solving your problem for whether your entry analysis is correct, whether you have the magic juju in your analysis that would allow you to take the trade. If you add a risk component analysis into that by saying, oh, if I put my risk here, then I got to do this, or if I put my risk here, then it could be this. I've got two components to my analysis. I have a risk component and I have a profit component. My rules for entry analysis, it's a single rule, it's a single problem. And the problem that it's solving is the profit. It doesn't solve the risk, because the risk is taken care of in the trading plan. And so if you are managing your profit expectation and your risk at the same time, you're not doing a one-path solution. You have two components to that. You're looking at the profit and you're looking at where do I put my risk. If you're looking at two things, you have four different profit solutions or problem solutions. If I have choice A and choice B, if I have choice A being I'm looking at the profit situation and choice B being I'm looking at the risk component, I have two choices. So I can just look at the profit A, or I can just look at the profit B, or I could look at the profit first as heavy weighting and then B, or I can weight the B first and then look at A. So I have four possible solution paths with just two decisions. And that's why I say don't put risk analysis into your framework of your trading rules. It isn't. Risk is not part of a trading rule, and it can't be, because it complicates things. Because then you're saying, oh, I have a profit component, I have a risk component, and I have to hit this line. Now I have, like it's got to go through a resistance point. Now I'm considering three components. Now, instead of 4 permutations, I have 15 different permutations. Man, I'm telling you guys, I don't know where you're learning this stuff from, but when I talk to people, I always encourage people to call me, not call me, don't call me. I don't answer my phone. Send me an email, and let's discuss this stuff. I'm not going to try to sell you something, because if you are interested in taking instruction from me, great. I have a 6-week fast-track trading plan, and we could talk about that. But I usually don't talk about it unless the person asks me, because I'm not selling the program. It's just me that teaches the program. I have a manual, and I teach the program. So I don't have a lot of time to do that. I'm retired. I'm not going to spend 40 hours a week running an education business. I'll work with a few people. That's it. So if you happen to hit me at the right time, I could take you as a student, but I'm not trying to sell you anything. So don't worry about that. If you have a question about something, I'll try my best to answer that for you. I can't answer a process question for you, because that's teaching. You have to have a process to do that. So I don't answer process questions, because I can't. I don't know who you are, how old you are, what your job is, and your education, and all the rest of the stuff. But if you come to me with a problem, why isn't the Golden Cross system working for me? I can answer that for you, and I can give you a solution, because that's a question about a problem. So when we're looking at the general Forex market, and people do call me, and we're talking about it, I am astounded by the complexity that most of you are using in order to solve your entry analysis, just the entry analysis part of your trading. I don't see how anybody could possibly teach that shit to you, or how you could logically come to the conclusion that this is the system that I want to use. And I have to be honest with you. If in my discussions with you, you say, "Gee, what's your trading plan? How would I take your fast track course?" If you've asked me questions that you're trying to prove why your system, you're trying to get me to tell you how to make your system work, and I refuse to do that, because if I thought your system worked, I would teach it, and then I would know how to tell you to do it. But if you're talking to me about, oh, I'm trying to, here's my system, and I'm trying to do this, what am I doing wrong? I can tell you right away what you're doing wrong, but I can't tell you how to fix what you're doing wrong. I can only tell you what you're doing wrong. If you want to learn how to fix that, you'd have to take training from me. Now, maybe you just want to do some consulting. You could do that too. But the number of people that I answer that question, they tell me, what am I doing wrong here? And this is the system I'm trying to do. Well, first of all, this system won't work because of this. Well, how about if I use this system and combined it with this one, then would that work? And then I answer that question. And then they say, well, if I did this, would I be able to do this? And then I say, look, you're asking me process questions, and I can't answer that. Well, let me ask you this question. And really what they're doing is they're not listening to what I'm saying. And they're trying to get me to help them solve some stupid fucking problem that doesn't even deserve the value of being solved. If that person turns around and says, tell me about your fast track trading program, I'll say, there's no point in it, pal, because I can't take you on as a student because you're going to argue with me. And there's no point in paying a lot of money for a course if you're going to argue with the teacher. You don't go in to take a calculus course to argue with the fucking calculus teacher. You go in to learn calculus, and there's a certain way to learn it that it's most productive to learn. But you need the teacher there to teach you that. The reason you don't think you need a teacher is because you have all these people out there that are giving you these systems that appear to work. Golden Cross is one. London Open is one. Engulfing candle patterns, oh my. God. If you have questions about what I've just talked to you about, why I only trade the Forex major pairs, please send me an email. Let's get a discussion going about that. I'd love to chat with you. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.